So, are we living through the next great tech revolution, or are we just watching the biggest financial bubble in a generation inflate right before our very eyes? That right there is the trillion-dollar question at the heart of the AI boom. Today, we're going to try and unpack this intense debate. The ghost of the dot-com crash hangs over everything in the market right now. And everywhere you look, people are asking the exact same thing. Is this just history repeating itself? Is this whole AI frenzy just a replay of that irrational exuberance from the year 2000? Or is something fundamentally different this time around? So in this explainer, we are going to tackle that question head on. First, we'll look at the parallels to the dot-com era. Then we'll build the strongest possible case for an AI bubble. After that, we're going to flip the script and look at the powerful counter-argument. We'll even uncover this strange self-feeding financial loop, try to solve the market paradox, and finish with the single biggest question facing investors today. Okay, let's just set the stage here. That feeling of déjà vu, it's everywhere. You've got skyrocketing tech stocks, all this talk of a new economy, and valuations that just seem to defy gravity. I mean, it's a story we've definitely heard before, and the parallels to the dot-com bubble are pretty hard to ignore. Now, what's really fascinating here is the sheer scale of it all. Yeah, the NASDAQ is way higher, but just look at the top company. NVIDIA's $4 trillion valuation absolutely dwarfs what Cisco was worth at its peak. But here's the real twist. Look at investor sentiment. Back in 2000, it was just pure euphoria. Today, more than half of all fund managers are already calling this a bubble. There's this level of skepticism floating around that just didn't exist back then. All right, so with that historical context set, let's put on our skeptic hats for the minute. We're going to build the strongest case we can that we are, in fact, in a massive AI bubble, and it's being fueled by some serious speculative excess. And believe me, the red flags are waving. Okay, first piece of evidence, just follow the money. And this really shows you the concentration. In the first quarter of 2025, a staggering 58% of all global venture capital, we're talking more than half the money from investors looking for that next big thing, it all poured into one single sector, AI. This isn't just an investment, it's a flood, and it's crowding out pretty much everything else. And it's not just the numbers that are telling the story. You've got seasoned experts sounding the alarm. Investing pioneer Rob Arnott is calling this a big market delusion. So what does he mean by that? Well, he's saying that while the technology itself is real, just like the internet was, the market is betting that the payoff is going to happen way, way faster than it realistically can. The story is right, but the price tag is all wrong. And just how wrong could that price tag be? Well, let's take OpenAI, the company behind ChatGPT. It's reportedly being valued at 135 times its revenue. Now, to put that into perspective for you, at the absolute peak of the dot-com madness, the most hyped-up companies almost never traded above 25 times their revenue. We are in completely uncharted territory with valuations like this. Okay, so the case for a bubble seems pretty solid, right? But just when you think you're ready to cash out and run for the hills, there's this incredibly powerful counter-argument. So let's look at why so many people believe those famous last words, "this time is different," might actually be true. The single biggest difference between now and the year 2000 is profitability. The dot-com boom was built on a foundation of unprofitable startups just burning through cash. But today's AI boom, it's being led by some of the most profitable corporations in human history. We're talking about established giants with enormous cash flows that are funding this whole expansion. And you can really see that difference on a market-wide level right here. The forward price-to-earnings ratio, which is just a key way to measure how expensive stocks are compared to their profits, it tells a really clear story. At the peak in 2000, the NASDAQ 100 was trading at a breathtaking 60 times future earnings. Today, it's around 26. Now that's still high, but it's less than half the level of the dot-com bubble. And here's the thing. Unlike a lot of those dot-com companies that didn't even have real products, AI is already here. It's not some hypothetical thing in the future. Nearly 80% of organizations are already using it. ChatGPT got to 100 million users in 2 months, something that took other apps years. And the companies at the center of it all, like NVIDIA, are seeing real, tangible, explosive revenue growth right now. All right, now we have to dig into one of the most unique and, honestly, one of the most controversial parts of this AI boom. It's this phenomenon that kind of complicates both arguments, the bubble argument and the real deal argument. It's this strange self-feeding ecosystem where the industry is basically funding itself. It's this concept called circular financing. So here's how it works. A big supplier, let's say a chip maker, invests a bunch of money into its own customers, like AI startups. Then those startups turn right around and use that exact same money to buy the chip maker's products. It creates this closed loop that can make growth look a lot more organic than it might actually be.
So let's trace the money to see how this works in the real world. Step 1. A supplier, like NVIDIA, invests billions into its customers. Step 2. Those customers, who are now flush with cash, use it to buy the one thing they need most, NVIDIA's chips. And then Step 3, the payoff. NVIDIA's own revenue and stock price get a huge boost from sales that it effectively financed itself.
So where does that leave us? We've got these bubble-like valuations and really speculative behavior happening at the exact same time as strong corporate profits and real-world adoption. It's a true market paradox. I mean, how on earth do we make sense of two stories that seem to completely contradict each other?
Well, the key to unlocking this whole paradox might be to stop thinking of the AI boom as just one single thing. Instead, what if we see it as two separate phases that are playing out at the same time? Let's call them AI 1.0 and AI 2.0.
And this distinction, this is the crucial point. AI 1.0 is the phase we're in right now. It's the picks and shovels gold rush. You've got massive spending on the fundamental infrastructure, things like chips and data centers. This is where all that circular financing and bubble-like behavior is happening. But the entire bet is on AI 2.0. That's the future payoff, where all this stuff actually starts delivering huge, measurable productivity gains across the whole economy. So this table really pulls it all together. See, on one side, in the AI 1.0 column, you have all the signs of a bubble. The VC concentration, the circular financing, those insane startup valuations. But on the other side, pointing to the potential of AI 2.0, you have real strength. Huge corporate profits, high adoption rates, and more reasonable valuations for the whole market. The paradox isn't a contradiction. It's just a reflection of these two different phases.
And this whole framework brings us to the final and definitely the most important question. The market is betting billions and billions of dollars on this transition from AI 1.0 to AI 2.0, from just spending money to actually earning money. But will that transition actually happen? This right here might be the scariest number in this entire debate. A shocking 95% of organizations that are pouring money into generative AI are not yet seeing a measurable return on that investment. This is the monetization gap, and it is absolutely massive. The spending is very real, but the payoff, for now, is largely a promise.
So ultimately, the long-term health of this entire market and whether this whole thing ends in a historic boom or a spectacular bust, it all depends on bridging that gap. The AI 1.0 spending spree has to eventually translate into AI 2.0 profits, because if it doesn't, the entire foundation of this rally just collapses. And that leaves us with one last provocative question to think about. We know the infrastructure is being built on a scale we've never seen before. The digital railroads of the 21st century are being laid down as we speak. But will the economic revolution, the real tangible productivity gains, arrive in time? Or will the massive bill for all this spending come due first? The answer to that is going to define the next decade of technology and finance.